Hey, everybody. Good afternoon, good evening, good day, and good morning, depending on where you're tuning in. It was a very active week this week that we just closed, and overall, it was a good week for the Nasdaq. But the S&P made it through the week down just a little bit, down about 0.88%, and that's not too bad considering that the S&P is doing really well for the year, up 22% over the past year, and over the last couple of years, doing great. It's up above 50% in value over the course of 2 years. So that's just a phenomenal rate of return. So this year, especially the months of September and October, things have gone better than I expected. And I'm a long-term investor. I like making money year in, year out. And the mission has been accomplished for 2024. I've made a good return. I don't see how in 2 months left in the year, I'm going to lose that much in 2 consecutive months to have a bad year. So we'll see how things go from here. We have an election coming, and typically elections tend to drive a lot of anxiety, a lot of fear. And this one, we haven't had a massive sell-off in stocks. I think the earnings have been okay. I'm going to look at a couple earnings that have come out, some highlights. I'm definitely going to look at Tesla and see what they had to announce. I know it's a couple of days old, but I'm curious to see how their revenue is doing, how their profitability looks. I'm going to look at ServiceNow. I'm going to look at UPS. I'm going to look at ADM, NEP. I'm going to look at Goog, which is Google, and take a look at some news that they had today, as well as Union Pacific, which is a stock that I've been looking to buy into when the price gets right. So let's see what they had to announce, see if there's an opportunity to get into that stock. So this week, I wasn't able to stream a whole lot, but it's good to be streaming today, kind of catch up on my investments. One of the benefits of being a long-term investment is you can kind of leave your portfolio for a week, 2 weeks, a month, whatever, and you can go do something else, come back, and just see how your stocks did. And that's been the case this week. It's been very passive on my part, and that's why I'm a long-term investor. I appreciate Shadow Guy being on, Android PC. Thanks for joining. Looks like Android PC. Tesla is back. And start the attack for 300. And you hope that political implications of Elon will not get in the way. Yeah, I can't comment on the latter. I have no idea. But we'll see. I'll give you my review of Tesla. And, I'll be first one to volunteer that the Tesla stock is not like any other. And I'll give you the rest of the comments when I look at the stock, because I'm going to look at the earnings and so forth. All right, so the market kind of ended a little bit down for the S&P, but the Nasdaq did well. When we look at the earnings calendar, was full of companies, but the big major companies are coming up next week. We have Microsoft announcing, among others. When we look at the different sectors for today, communication services did really well because Google, I think, is the biggest market cap company in that sector. It did really well today. So that particular sector did really well. Technology, it's doing great. Consumer discretionary had a good day. Energy was up because oil prices were up. Now, as for stocks that were down, utilities were down, financials were down, real estate was down. And today, in the early hours of trading, stocks were up considerably, and then they gave up those gains and kind of settled down. So it was interesting how the day played out. But we're in a really good 2-year run. You look at all sectors, they're doing great, especially technology. And you look at consumer discretionary is doing great. Healthcare is doing okay. Things are just really looking really good. And it seems like some small caps are beginning to work, which is good to see. One of the trades that I'm looking at is the Chinese trade. China stocks had a good day today. Alibaba was up more than 1%. JD was up 1.45, and JD's had a pretty good week. and other stocks were fairly in the green. So China stocks work today. We'll see how those play out. We'll see if they're going to have a long lasting rally or if they're going to continue to bump along the bottom, but we'll see. All right. So let's get into some stocks. So Google Alphabet, this is one of the companies that I just have a very high regard for. And the reason for it is, starting with their primary business, which is search. Nobody does it better. These guys have become so darn powerful because of their search and their ability to have the best algorithms. But they didn't stop there. They continued to get stronger, better. They acquired YouTube, but they really made it into a very, very powerful company. Now, YouTube has the most subscribers and streams more than any other platform, including Netflix. The advertising revenue on YouTube is really profitable. YouTube, they don't have to buy content. They don't have to produce content like Netflix or other media companies. They could just let their community members and streamers and video producers create content and bring it to YouTube. So it's a really, really good business. So their businesses are really strong and powerful. And I happen to think today the stock really worked. It was up 1.5% because what was announced was that they have another business that is completely owned, Waymo, and they secured additional capital to expand that business. They're currently operating these autonomous vehicles, fully robo-taxi business. They have it in San Francisco, a part of Los Angeles, Phoenix, and they want to expand. And I believe this expansion is going to include Atlanta, Georgia, as well as another city. And I forgot the other city, but in general, this is one of the businesses within the Google Alphabet stock. And I feel like as an investor, I'm getting this business at no additional fee. It's like included in the stock price. I don't think, analysts really include the valuation of this company. Now, if Waymo becomes a substantial business and it gets spun off, I'll get shares in Waymo. And beautiful. I'll have shares in a true AI business. That's robo-taxi. That's another platform business where, Google Alphabet's making partnerships with like Uber, who would then use their platform and have robo-taxis in 2 cities. And that type of business is really profitable, and it will allow Waymo to grow. Waymo is the largest robo-taxi business currently available. It's the largest. It's not all talk and no details or no facts. Waymo's the opposite. They've been doing this for more than 10 years. They could show you track record. They could show you how expensive this has been. It's been a money-losing operation because it's so forward-leaping. But now it's beginning, the economics are beginning to balance out. And again, if robo-taxi takes off and this becomes $100 billion revenue business, might be worth $500 billion, $1 trillion in value, and I'm going to get shares. So it makes me, again, glad that I invested in Google Alphabet. This has been one of the pieces to the whole Google Alphabet story that I've liked about the company, is that they have great businesses today that continue to get larger. They have great moats, and they're going to be just fine. But they have these businesses like Waymo that are just expanding and are going to be worth so much, as well as their cloud business, which is doing great. So overall, I really, great news that the Waymo business is going to expand, and it's glad to be a stockholder and seeing it as part of the company. So that was the news around Google. It had a very good day. The stock was up 1.5% over the past year. It's up 19%. It really gave up a lot of gains. It hit its peak July 10th, and it really gave up a lot of the gains. Over the last 5 years, it's up 164%. I happen to think out of the big Magnificent Seven stocks, this one might be the best one because it hasn't really gone up in the same proportion as the others. So I believe it's a little undervalued. In fact, I'll show you how I value the stock. And I continue to add shares. When shares are sold off, when this stock sells off, I buy shares. So right now, I think Goog shares are discounted by 35%. The cash flows get me to about a fair price, but the earnings per share just really impress me. And I value the company based on earnings per share at a pretty high amount. They continue to grow their business. If we look at their revenues, they continue to expand their business. Look at these growth rates. And they're a massive company, $328 billion in the trailing 12 months, and they still grow at 13%. That's phenomenal. They're growing at a portion that's like just massive. So they continue to add more revenue and more profit, buy back more shares, and create more value. So overall, I'm a big fan of Google Alphabet and glad that it's the second most valuable stock in my portfolio. So speaking of these big valuable companies, let's take a look at Tesla. And right before I jump into Tesla, let me catch up on comments. Of course, Android PC is ready to talk Tesla. So he's ready to go on Tesla. Yeah, I guess, if you own the stock and they do spin off shares, but I think the ETF would still get the shares, but it would just be kind of pooled inside of the value of that ETF. So I think the ETF would still get the shares. So you would still benefit as an ETF owner when let's say Google is in that ETF. That's what I imagine. And then Android PC, sadly, Waymo is an IPO, so I settle with Tesla for now. Okay. Then Michael Benitez. Yeah, good to have you. Thanks for joining in. Do I think Tesla's going to come back within a few weeks? Let me answer that. Let me take a look at Tesla stock. All right. So Tesla, I think most people know what it's all about. Their cards have been out for a long time. The stock has kind of gone sideways, long term over the last 5 years. You look at their peak, they hit their peak November 1st, 2021, have never gotten to that stock price again. There has been opportunities to buy the stock at, I guess, low points, and it's really rallied, especially recently. It's really rallied well. Over the last month, it's up 5.87%, but look at this rally here. I like looking at this chart real quick so I can show you the level of appreciation over the last couple of trading days. So over the last days, it's 23%. It's up 26% over 2 trading days. That's phenomenal. Wow, that's incredible. So what did they announce? What was so red hot? Let's take a look. So the company is a big cap, $859 billion. Revenue is $97 billion. PE is really high, 73. Forward P is 89. Analysts think it's priced a little too expensive. It's expensive by 19.5%. Now, when we look at the revenue, this is what I think concerns investors is the revenue is not growing very fast. I just showed you Google Alphabet. That's more than 3 times bigger, growing at more than 13%. This company is growing at 1%. Let's look at the quarterly. So the quarterly, the revenue grew by 7.85% compared to the previous year, which grew at 8%, was at 23.3 billion, but now that they're at 25.1 billion for Q3. Looking at their profitability, let's look at their gross margin first. So out of $25 billion in revenue, they get to keep about $5 billion. So that's about 20% gross profit. That's one of the big sticking points when I look at a company like that. Let's go back to our friends at Google and show you the big difference. So Google, they sell $328 billion of revenue, and the gross profit is $189 billion. That is about 60% gross margin. 60 versus 20. Obviously, the 60 is far more valuable than 20. And this is representative of a car company. Car companies operate with these types of gross profits. You think about, you create this revenue, but to deliver this revenue, cost of revenue, are cars made out of steel, tires, wheels, electric motors, batteries, components and materials that cost a lot of money. So the gross profit is not very attractive. And that's one of the undesirable aspects of Tesla for me as an investor. They don't generate a ton of net profit because there's very little left over. When you think about how much revenue they just produced, their net income is $2.1 billion. That's less than 10% of their revenue. Not a very profitable business. But their excitement is created by their CEO. Their CEO is, to say he is popular is an understatement. He's a rock star CEO. He's a rock star to many. I mean, many people believe in the CEO. Their free cash flow in the quarter was $2.7 billion, which is far better than last quarter. But they did have a negative quarter in Q1 of 2024. When I look at an annualized free cash flow rate, they cash flow at $3.6 billion, and it's okay. But again, if you ever want to call Tesla a technology company, look at the fundamentals, right? 3.6 billion. Okay. Now let's look at a tech company. What is Google Alphabet's free cash flow? 60 billion. It's like a whole different universe of cash flow. 3.6 billion, 60 billion. This is a true technology business that creates technology that is so valuable. The idea is so valuable. The intellectual property is so valuable that they get to keep far more profit, far more cash flow. Whereas a car business, you don't get to keep all that cash. You don't get to keep the profit. You have to pay materials and people to work on the cars, to assemble them, to build them. Quality, service, all those things really add up. So that's another undesirable aspect of Tesla is it's not a very high free cash flow producing company. It's a rock star CEO with a car company. Now, Tesla would tell us that, hey, we got this robo-taxi idea, and when we come out with it, it's going to be the greatest. Now, an announcement that came out a few weeks ago was poorly received by the market. Now, the earnings that they announced was partially very good news that they did grow their business by 7 or 8%. They did have better cash flows, and the CEO guided that next year they're going to grow 20-30%. I don't believe it. And the reason for it is a couple of fundamental reasons. First, the competition is tough in car businesses. It's not like Tesla created the car industry. They're just a new player in an industry that's been around for more than 100 years. You have Volkswagen that's coming out with some really attractive EVs. You have Toyota, that's a very high quality company. They have both their hybrid lineup, their EVs, they even have hydrogen cars. So you have a lot of competition. Mercedes is coming on strong. So the consumer is going to have more choice. And the consumer, in the car business, you have some loyalty. But I would say that loyalty only goes so far. I think people like trying different models of cars. And then, of course, with age, people have different styles of cars. When I was in my 20s, I had a Toyota Supra. It was a great car. It was cool. It was fast and all those things. And then in my 30s, I settled into a big truck. It was an off-road truck. And now that, fast forward 2 decades, I have a sedan and I almost never drive. So preferences really change over time. Tesla, I think, is going to constantly deal with where is the refresh of customers going to come from. Cars last long now. So I think they're going to have a lot of challenges in growing their company. And I could be wrong, but I could also be right. It's not the first time that Elon Musk has promised something that didn't happen. They promised the Cybertruck for 3 years and finally delivered it. And his fan club was pretty forgiving. They were like, "Oh yeah, no big deal. All right, we forgive you. We'll just keep buying your stock." But most other companies, they get punished when they guide and then they miss, they get punished. But not Tesla. It's been interesting to see that. All right, so what do I value the company at? So, needless to say, I'm not a big investor in Tesla. I did own Tesla a long time ago and sold my shares. I think Tesla stock is overpriced by 78%, not even close. And the reasons for it, very low cash flow. They don't produce cash. They're not a technology company. They can call themselves a technology company. People can call them a technology company. But if you stack up their financial statements against true technology companies, you see that Tesla does not belong in that category. They belong in the category of a car business, because if you compare Tesla with Toyota, with General Motors, the financials look very similar. Gross profit margins look similar. Free cash flows look similar. So I'm going to call it a car company. Having said that, I value them based on the cash flows that they produce, and they come in way short of the valuation of the stock based on market cap. If we look at the earnings per share, you can't get there to the stock price. Now, once a stock becomes completely detached of fundamental valuations, and it's just like people are imagining, projecting based on their imagination that, no, this company is going to be a $500 billion revenue company. It's going to do solar, and it's going to do autonomous driving / robotaxi, and it's going to do all these great things. And it may well do all those things, but the reality is they're not the robotaxi leader. Google Alphabet is. They really do have a business that's going. They're partnering with some really powerful companies like Uber. And we're going to see how this plays out. The other concern I have with Tesla is that their CEO is really the CEO of 3 big businesses, and he's very politically involved at this time. Now, I don't really have an opinion of his political preference. I'm just making the point of he spends time managing Tesla, SpaceX, and X. So he has these 3 big businesses he's trying to manage. And then he's also trying to manage an election. That's a lot for a CEO to take on. Just being CEO of one company is incredibly difficult. And if I'm an owner of a business and the CEO is working part-time for me, I would not be comfortable with that situation. I'd actually be very uncomfortable. And I'd probably ask the CEO to either commit completely to being full-time to running the company that I have, or maybe move on and we get a CEO that really wants to focus on that particular business. I'm just observing that he's superhuman, maybe, but maybe he's not. Maybe he's a little distracted and the company is not going to perform as well as it can. And maybe that's why there's been so many delays on cars. The Cybertruck was delayed for 3 years. Robotaxi. I've heard about Tesla Robotaxi for 5 years, but we don't have anything truly in the field, truly being used in any market. So that's my opinion on Tesla. Is really overpriced. Elon Musk has a terrific fan club, and this fan club buys the stock, as well as a bunch of big investors. Some big investors really believe in the stock. And hey, they've had a very good month. Some more power to them. I hope if you own Tesla stock, you make a lot of money. But the reality is that I expect that this stock over time is going to go down substantially. And if we look at the history of the stock, at certain times, this stock has sold off tremendously. Here it sold off 72%. Just in 2024, it sold off 41%. Holy smokes. So this stock is not, I'm not the only one thinking along these lines. I heard Jim Cramer, which I know some people don't like. I respect what he says. I don't agree with everything he says, but he said just a couple of days ago that he considers Tesla a car company and that it's highly overpriced. So I happen to agree with Jim Cramer on that note. So that is Tesla. Incredible company. Incredible that they got EVs, to market. But I just think the company is way, way overpriced. All right. So got a lot of comments coming in. Thank you so much for tuning in, everybody. Let me try to make sure that I read all these comments. So Michael, thanks for joining. I don't think Tesla's coming down within a few weeks. I don't know. I'd rather say I don't know, and we'll see what happens. But right now, I mean, the sentiment's pretty popular, pretty positive. So my guess is it's not going to come down for a couple months. So Mercado Libre, this is Nichix. Very good to see you. MELI is a free cash flow beast. It certainly is. And it's also has a very high market cap. And I had to pick between Mercado Libre and Amazon, and I'm buying Amazon. Amazon is better diversified, has terrific cash flow, has great growth, is doing all good things, a lot of good things, I should say. So I am good with Amazon, and I own some Alibaba. Michael Benitez. Yeah, I think you're still talking. I'm not sure which stock you're talking about there. Yeah, so Tesla is below 1% yield. I agree. Yeah, Tesla's a tough one for me to value, and I kind of shared my sentiments with you there. Then Carolyn Robowski, Hims. So you guys are talking about Hims and Grindr. Oh, Grindr's a stock. Okay. So I'll take a look at that one. And Hims. Okay. See if we have time for those guys. All right. So we went over Tesla. Now there was a community member request to take a look at ADM and NEP. So let's take a peek. We're going from high flying Google, Tesla, but let's talk about food. The food industry can't live without it. And ADM is going to announce on November 5th. So that is going to be next week. It's coming up. These guys have a market cap of 27 billion and they have revenue of 88 billion. Over the last 5 years, the stock has been giving up its value from $97 per share in 2022 down to 56. Is it an opportunity? Is this thing a nice valuable stock that we could buy in a food company? They pay a nice dividend at 3.5%. That looks pretty good. Really low PE. Now, the food industry saw something that was unusual, probably isn't going to happen for a while. As inflation hit, you see these growth. You see this growth in revenue. 2021, it grew 32%. Holy smokes. That's because the inflation on food just jumped up. And it continued on in 22. That inflation is going away and revenue is coming down. So the company's still operating really well. It's still doing what it's supposed to be doing, but it's the price that they sell the food for is less. Now let's take a look and see if they're still profitable, because I can understand that their revenue is dropping, no fault of theirs, right? Commodity prices are down and things are settling down. When we look at pre-tax, let's look at net income. So net income has been good. Before COVID, they were net income 1.6, 1.8, 1.3, 1.7. Now they're 2.6, 3.4. I mean, the profit's there. So very good. When we look at free cash flow is at 3.1. That's pretty good free cash flow. When I look at free cash flow of 3.1 billion, they're not growing, but they're a food company. I'm going to multiply that times 15, and I would get so I'm going to get about 45 billion in market cap. That's where I think the company is fairly priced. And it's at 27 billion. So this is an opportunity stock. This is maybe not set a record that, oh man, I'm going to double my money in a year or 2 years. But I think over time, this could be a very good stable stock that pays back investors. It's not going anywhere. We need food. And this is a solid company. It's been around for a long time. Dividend is good. This is looking pretty good to me. If it's worth about 45 billion in market cap, let me take a look at their debt really quick, just to make sure it's not overly indebted. When we look at their balance sheet, so total debt, so net debt, which is debt minus cash, is about 11 billion. And when we look at their EBITDA, it's 4 billion. So their balance sheet's okay. It's less than 3 times EBITDA. Debt is less than 3 times EBITDA. So balance sheet's okay. I think the stock is priced at a discount. Right now, technology's been doing phenomenal, just doing great. Communication services doing great. It's not a bad idea to add ADM because right now the stock is discounted. If we look at the 1 year, it's sold off 18.5%. They're going to announce soon. Inflation has been stable, meaning it's we still have some inflation, but it's acceptable. It's within reach of that 2% target that the Fed has. So overall, ADM looks good. Looks really good. I think Mike, the dividend investor guy, wanted to look at ADM. He also wanted to look at NEP. That's NextEra. We're going to take a look at that next. Tomas, very good to see you. Buenas tardes, buenas noches. And Android PC, I think I already said hello to you. How you doing? And I think I'm caught up on comments. All right, so NextEra Energy. Over the past year, they're down 18%. Now, NextEra, let me get reacquainted with these guys. NextEra Energy Partners acquires, owns, and manages contracted clean energy projects in the United States. It owns a portfolio of contracted renewable generation assets consisting of wind, solar, and battery storage projects. Okay, looks good. So power companies have been all the craze, especially the independent ones. This one seems to be discounted according to what analysts think. Has a huge dividend. Holy smokes. Look at this dividend, 17%. Is it sustainable? We'll take a look. Let's take a look at their financials. Market cap's a little under 2 billion, revenues 1.17 billion. The revenues have been expanding, so that looks good. Are they profitable? Let's take a look at the profitability. Net income. They are profitable. Okay, very good. What's their gross margin? So they generate revenue. And they're not giving me kind of a gross margin. They're kind of taking everything off of it because it is a power generating company. It's not like they're making something and then, shipping it off to customers. So their operating income is pretty tight. All right. So looking at cash flow, free cash flow, trailing 12 months, $302 million. They did have negative cash flow in 2023 and 2022. That's one of the aspects I don't like about utility companies is they have to spend so much on CapEx that it takes away all the cash. And you can see this CapEx spend. That's a lot of money to be spending just to keep the business operating, which is one of the things I don't like. That's the big red flag for utility companies in my mind. So it's still having to deal with that. They did generate $302 million. It's a utility company. So the best I can do is like $3 billion minus debt. So when we look at their debt level, they have $5 billion in debt. So they have $5 billion in debt. The market cap's only $2 billion. So this one here is untouchable to me. Just the big red flag is the debt level is $5 billion. Their cash flow is worth $3 billion to me. So it's like there's not enough value here. I actually think based on free cash flows, this is an undesirable business. It doesn't produce enough cash. Now, if you just focus on earnings per share, some analysts will say, well, no, this is a $37 stock. On average, they say it's a $26 stock, but this is based on earnings per share. And earnings per share wise, they do produce a good earnings per share, but it's supposed to go down. So that is not looking good. Maybe that's why the stock's selling off so much. So NextEra is not a stock that I would entertain buying. Just the CapEx is too high, cash flow is too low, debt is too high. So too many red flags. The first one we looked at, ADM, I like, but not NEP. All right, so we looked at Google. Now let's look at another solid company. It's been around forever. Union Pacific announced on the 24th. And they announced on the 24th. Today's the 25th. And the stock sold off. Is this the opportunity for me to buy Union Pacific? I've been wanting to buy into this stock. It's a $139 billion market cap company. Revenue is $24 billion. You might say to yourself, wow, how come you're getting like 5-6 times sales for this market cap company? And it's because rails have really strong monopoly power. They're granted these monopolies because they built and invested in the rail system. And that's why they get to keep good, steady revenues, good, steady profits. Their PE is 21, not bad. 19.6 is the forward PE. Dividend is okay at 2.33. It's a buy according to analysts. And let's take a closer look. So Union Pacific, and I do have a full valuation on this. I just want to look at their fundamentals. Let's look at the quarterly. So their quarter that ended September 30th, revenue did grow by 2%. That's good. We look at their revenue, $6 billion. Cost of revenue, 2.7. So even a rail company has a greater gross profit than Tesla. Union Pacific has well north of 50%. It looks like it's 55% gross profit margins on their business. Very good. That's why they have a good market cap of above $100 billion. So gross profit looks good. Let's take a look at cash flow. And I'm in the quarterly, so I'm going to go to the annual so I can see the trailing 12 months of free cash flow. $5.5 billion. It's a desirable industry to me, so I'm going to multiply times 20. Gets me to $110 billion of value based on free cash flow. And let's take a look at their balance sheet. how much debt does Union Pacific have? They have $31 billion of net debt. Man, that's a lot of debt. Their EBITDA is 12 billion. So they can pay off that debt in less than 3 years, but it's still $31 billion. So it gets, when I look at their market cap compared to their free cash flow, it's just hard to get there with this stock. I'm basing their free cash flow is going to be about 5 billion in the first year of my forecast. And then I grow that by about 5%. This is a steady industry. And the best I can do is 188, equity value 155. So it's 11% discount based on free cash flows. Let's take a look at the earnings per share. I'm going to give them a P of 20, which is realistic for them, growth rate of 8%. So let me just make sure I have my earnings per share is current, because it's looking like it's slightly discounted. Might be worth buying, because I've been wanting to buy into Union Pacific for a while. All right. So some analysts think it's a $283 stock. Some analysts think it's $210, but you can see there's a lot of respect for this stock. Nobody's really saying, oh, this is a highly overpriced stock. And 2025 earnings per share is $12.62, and it's growing at roughly 10% or more, $12.62. So that's pretty good, $12.62. Yeah, so I think Union Pacific, the type of business it is, I like the business. I think it's a good business to own. I've been waiting and waiting and waiting, and I might need to buy a few shares because this is an opportunity for me. So I might, I'm going to do some more homework over it over the weekend, and I might end up buying into Union Pacific, and I'll have a rail. I'll have a rail in my portfolio. Nice, steady rail. When you look at super investors, Warren Buffett, even Bill Gates, those guys own rail lines, and they just think the world of railroad companies. So I've been patient. The stock's come down. It's discounted. Maybe it's time to act. I will give it some thought. Looks like Mike, the dividend investor guy, is on. And I covered NEP and ADM. And I'm sorry that you weren't on when I covered them. But to do a recap, I thought ADM looked great. Looked really good. NEP, not so much. I don't believe in NEP. I think they have too much debt. And they do have free cash flow at the given time. That their CapEx is so darn high. It just takes all that cash away from the business. So I had a positive opinion on ADM. That looks good. I might look at that stock, but NEP was a no-go for me. And you can look at the recording, Mike, if you'd like to look at my comments. But thanks for nominating those. Shadow Guy. So we're back to Google, and if they spin off Waymo, would you get the shares? Yeah, I guess, I'm getting out of my realm of kind of knowledge, and I kind of wouldn't know how an ETF would deal with those shares. I'm just kind of using logic and saying, well, you own that ETF owns the Google shares, so why wouldn't they be granted those additional shares of Waymo once they were granted? But you'll have to look into that. Interesting. It looks like Mike, the dividend investor guy. You have a lot of ADM and you have NEP. Yeah, NEP's been selling off, and it's interesting where the stock's going. Again, I haven't liked utilities. That CapEx line looks terrible. It seems like they have to rebuy their business every 2-3 years. And it's like, why own a business where you have to just constantly be replacing all your machinery in order to stay in business? That just seems like an undesirable business compared to like a Google Alphabet that's like producing really high margins. It seems like their search business just continues to operate. The YouTube business continues to operate, just really desirable business. But I'm glad I covered them for you. Good luck with that. We covered Tesla earlier. All right, let's take a look at ServiceNow. And the Now business is a software company. They're trying to really, ride the AI cycle. And let's see how they're doing. How you doing, Brad? Good to see you. You want to look at HAFN? Yeah, we can take a look at that. And I'm very familiar with ServiceNow. So I've been working in the software space for a while, and I'm very familiar with what they do. They compete primarily against Salesforce.com, which is the big company in their space. These guys saw AI and and I think most software companies have been saying, hey, we're an AI company. Now they announced, and they did have positive earnings, but I think the street is beginning to think, well, you're doing well, but I don't know that you're doing this well according to your financials. Let's take a look at their financials. Now, when we look at income statement, they're growing at 23%. They're a $10 billion company. In the quarter, very solid growth, 22% growth. Now, I'm going to compare them against their arch enemy, Salesforce, and see how they compare one against the other. Salesforce is 36 billion, so they're 3.5 times bigger. They're growing at 10%, which is very, very commendable. That's big growth for a big company. ServiceNow is, again, it's way smaller. So 10 billion. Okay, yeah, their Salesforce is 3.5 times bigger. Now, one thing I'll point out is they were growing faster before the whole AI, cycle. Then AI hits and there's growth starts to slow down because of the law of big numbers. They do have very good gross profit. Back to the software space, intellectual property. They do 10 billion in revenue and keep 8 billion in gross profit, 80% gross profits. That's why these businesses are worth what they're worth. This market cap for a $10 billion revenue company has a $200 billion market cap. That's why these businesses are worth so much, is that gross profit is so lucrative, a lot of gross profit. So you have a good gross profit. What about cash flow? Cash flow is at 3.3 billion. Very good. I would say the best I can do for these guys is they're worth about 90 billion. That's the best I can do. And they're valued at 200 billion. This is a business that resembles CRM in a lot of ways. They really have messaged their AI story far better, I guess. And you look at the CRM business, it's up 96%. These guys are up 300%. You could say, well, they have a higher growth rate. Yeah, I would agree, but they're also way smaller. It's easier to grow at higher percentages when you're smaller. This one had a pretty strong correction in 22, along with a lot of other stocks. This one did as well. So one compared to the other, I think that the CRM business, Salesforce, is more attractive to me. I think that the software business is going to continue to contract to fewer players that keep a lot of the market share. And Salesforce will be one of the last software companies standing in the battle within this space. ServiceNow is somewhat of a one-trick pony. They do service very well, but what else do they do? Not much. That's all they do. CRM does Salesforce automation, service. They do e-commerce. They were trying to get into the cloud space, but were unsuccessful in really creating a big business out of that. So the long and the short of it is Salesforce is more diversified. They also own like Slack. So they have really good products and have a pretty broad portfolio of products that a company could buy. ServiceNow is somewhat of a one-trick pony. They can only do service. And that's one part of the overall capability, I guess, portfolio that a enterprise software company would offer. We'll see how far, ServiceNow is going to go, but maybe the announcement this week, they announced on the 23rd. they announced and the stock popped overnight and then it settled down. So really impressive that their stock went up, I guess about what, 5% in the overnight hours. I just think that ServiceNow is pumped up a little too much and is probably going to settle down because their solution is not revolutionary. It's quite it's been around. Like other software companies have been doing what they do. They just are telling their customers that they're going to use a lot more AI to handle service requests and so forth. And they're probably doing the same thing they were doing 5 years ago. They just call it AI, in my opinion. So that's where the stock is at. And I wanted to take a peek because it has been a high flying stock that caught my attention. So that is ServiceNow. HAFN. Let's take a look. And that's Hafnia. So Hafnia Limited owns and operates oil product tankers in Bermuda. It operates through long range 2, long range 1, medium range, handy size, and specialized segments. Transports clean and dirty, refined oil products, vegetable oil, easy chemicals. Okay. So it does marine shipping, transportation of oils. $3 billion company market cap, and the revenue is about 1-to-1. Huge dividend. Holy smokes. Look at the 5-year. It went up quite a bit. This is a small cap that went from $1.60 a share, and now it's $60.20. Holy smokes, that was a great move from 22. Look at that. So whoever bought here, congratulations. Not a lot of shares outstanding. Probably the volumes are pretty low. It's a strong buy according to the analyst. The revenue is expanding. And I think we've looked at this company recently. I think they acquired more vessels. These guys grow by acquiring more vessels, ships, and so forth. And they put more vessels into service. Looks good. High growth. Looks good. Now, this stock here, like shipping companies are not going to continue to compound and you wake up and, oh, this shipping company is worth $1 trillion. I don't imagine that ever being the case, but you could get value from a company if you buy at the right times. This company is showing this that, over the last year, the stock is down 6.6%, but over the last 5 years, it's really run up nicely, 74%. It's not bad. I guess they IPO'd around 22. So if you're in the stock, you're being paid a really nice dividend. Why is this not showing me a 5-year? Guess the IPO'd recently. So you've done very well over the 1 year and you've been paid this high dividend. Let's see if they can afford that dividend. So when we look at their dividend is $1.62. They're paying out about 100% of their dividend. Looking at it from what they pay, you can see that it varies. It's not one of these dividend aristocrats. It's just constantly increasing their dividend because their business is not as stable as, let's say, an ADM that we looked at earlier, which is a food company. It's a stable industry. People need food year after year. They're going to keep buying food. This one will go up, down, and so forth based on how profitable that particular quarter is. Now they paid on September 3rd, ex-dividend date, 40 cents per share. They paid it out on the 13th. Okay, so 40 cents per share. So it's $1.60 per share. If we extended that rate When we look at their cash flow trailing 12 months, their free cash flow per share is $1.86. So they can afford that dividend. So that's a big whopping dividend that they can afford. Even if they wrote down, like if they were like, hey, we can't pay $1.62, we're going to pay $1.25, you're still getting a massive dividend on the stock. Oil prices have been in the 70s. They've gone up a little bit this week. So that helps them. Boy, if you get oil prices to really move, let's say in the 80s, this stock's probably going to move because that's going to create more movement of oil. Like, hey, I want to get low cost oil out of the Middle East, bring it over to the end market. If you have low oil prices, hey, I'll just get it locally. It's typically more expensive, but now with a low oil price, I'm saving the transportation costs. So this is an interesting stock. It's not a name that is going to be very recognizable. So it would be, you're in for that dividend. And what might happen is, let's say you got into this stock and within 3-4 years, the dividend pretty much paid you back for the stock price. Then you'd be kind of playing with the house's money, right? If you had, let's say you bought the stock at $6, it gave you $1.50 dividend. After 4 years, they returned your stock price. Now you own the stock outright. And you're like, hey, you gave me back my investment. Now everything else I make on this stock is going to be gravy. So it looks good from that perspective. Let's look at their debt and make sure that debt isn't going to be a big problem. And they have $1 billion of debt, roughly. EBITDA, they make about $1 billion a year. So yeah, debt's not a problem. They can pay off debt in 1 year if they're really focused on it. But of course, they pay that dividend. So that dividend, I think, is looking pretty good. Looking pretty good. That's a high dividend rate. Yep, looks good. Trying to think of what other things would be concerns. So the balance sheet's okay. It's a bad name, right? Or not a bad name. It's an unrecognized name. So I don't imagine this stock's going to be $100 stock in the future. It's going to be, a low price stock. If oil really rallies, I could see this stock rallying. I wouldn't expect this stock price is going to go up much. It may settle down a bit. You're really investing for that dividend is what I would be investing for, but that's my observation of it. So good luck with it, Brad. Good luck with it. And it looks like Michael Benitez, HAFN is down 16%. It is. But with that dividend, I mean, they're returning at $1.62. They're giving you back like more than 26% of your stock price. So you're still up 10%, right? If you had bought like exactly 7 months ago, you got 2 dividend payments in that time. So you got like 50% of your investment back. So you're still in the green if you follow the numbers. Yeah, tanker stocks are all declining. Interesting. Maybe there's a glut of supply and they're expecting that, hey, we're not going to need these tankers as much as we did in the past. Maybe. That would be worth taking a look at. Right now, I'm not in a shipping stock. And I've been thinking about getting back in, but I'll tell you, right now, I'm in that zone of the year where, okay, I've got a very good return going. I've exceeded my expectations for the year. Wonderful. And I'm actually accumulating more cash. I'm getting out of Elevance just because I'm harvesting that loss so I can use it against some gains that I took earlier in the year. And I'm finding myself accumulating more cash. It's more comfortable to be in a little more cash right now than it is to be completely invested. And a little more cash is, I'm probably on 11% cash. If we look at my overall portfolio, maybe 12%. And as I move to 13, 14, it's not uncomfortable. Warren Buffett has been accumulating cash. Cash is being paid. Money market accounts are paying 4.5%. So I'm like, man, that's pretty darn good, especially if you smell a correction coming of any sort. You know, I'd like to have that capital available to buy some of these stocks that I want to own. I'm buying into some small caps. As mentioned, I'll buy into Google Alphabet. Additionally, right now I'm holding off from buying more shares of Meta. It's just too much in my portfolio. But I'll take it, man. For the month of October, I'm pretty much even. And my guess 2 months ago was we're going to have a bad month in September. We're going to have a bad month in October. Seasonally, it just usually plays out that way. We have an election this year. That's going to be a little extra, concern. And I would expect that it was going to go down. I had a very good September. Made it through September. Kissed my computer screen. Said, thank you. And at that point, I'm like, man, that's a really good year. That's a great year. But we got 3 months to go. If we end October flat, I'm good. And if I have a little extra cash, I'm good. I'm trying to figure out what's going to work for 2025. I'll try to figure out with you guys, I'm looking at companies, seeing where is that space that's really going to work for 2025. And that is the search. We'll see if the AI trade fades or if it just keeps going. We'll see if the China trade works. We'll see where this election goes. If the blue side wins, I think the solar stocks and some sectors industries will do well. Crypto's been really moving. And it's interesting because the crypto story is like, it doesn't matter who wins. There's kind of like field to both sides. It seems like both sides are okay with crypto, which is positive for overall for that asset class. So Trader Prad, thanks for joining, man. It's good to see you. Thanks for joining. So Brad, you want to look at BWLP? I think we've looked at that. And then Mike just bought into BWLP. So let's take a look. So BWLP is an investment holding company engages in ship owning and chartering. We looked at this recently. Now, I like the business like on description, right? They own the ships. So they don't have to operate them. Okay. It's almost like a real estate investment trust. They don't operate the real estate. Somebody else does, but they own the real estate and they get paid a more steady income. All right. So we know what they do, and they do limited partnership. Is this BWLP limited? What's their, I want to know what their company structure is, because if it's a limited partnership, it's important for me to know. But I don't think it's a limited. No, they do LPG, meaning liquefied petroleum gas. Okay. Okay. Singapore company. All right. Looks interesting. Let's take a look. All right. So market cap is 1.79 billion. Revenue is double that. And their net income is pretty damn good. 483 trailing 12 months. What's up with this stock? It's doing well. Up 200% in 5 years. It's up 7% over the last year. It had a really nice run up, and it gave up a lot of those gains down to $13.55 a share. It was once at almost $22 a share. Okay. So PE is super low, 370. Holy smokes. So these companies that are moving oil, liquefied petroleum, they're really selling off. But oil, I'm like trying to put the big picture together in my mind. Oil is not like super low. Oil prices are not super low. Now they did go down. They touched like the high 50s a couple months ago. So that did get a little, concerning, because if you get really, really low oil prices, oil companies lose money. This one here is being sold with a P of 370. That's like incredibly low. Dividend 24%. They pay $3.28. Looking at their growth, they're growing. They're expanding big time, adding vessels. Okay. They're profitable. They pay about $3.50 in dividends. Free cash flow per share is $5. Man, these stocks are looking good. Now, why are they offering such a great return? Why is it the case? I'm trying to find, what is the big risk? BWLP. So just based on the numbers, this looks very attractive. Let's look at their dividend history. So they paid out 58 cents, which was lower than the previous dividend. It's been up and down, but they've paid dividends, it looks like, every quarter. It looks good. I'm going to take a look at HAFN and BWLP over the weekend. And they both pay sizable dividends. And if you think about if oil prices, and you never know when markets can, throw a fit, and it could be caused by geopolitical tensions. I can't tell you when the next, bad moment's going to come. But when it does, oil prices tend to go through the roof. And that's what, when you buy a company like this, if you get it at a very good price, and then that moment happens, maybe that's a point where you go, okay, if this thing goes up 30, 40%, maybe I get out. And I made money a variety of ways. I made a great dividend, and then it shot up because there was tension between this country and that country, which created, a risk to the oil supply. All those things, could drum up the stock price, and then you get out and you made a very good return. It just wouldn't be a stock that, can I see this stock being in my portfolio for 10 years? Potentially. If it kept paying that dividend, holy smokes, who wouldn't want that? But I would also be ready to have an exit plan if the stock price gets to, let's say, $20 a share. I'm out. I'm good. I don't want to be greedy. I'll wait for it to settle down, and then I'll buy it again. So BWLP. So BWLP is buying 12 large gas carriers from Avance Gas. Interesting. Those are interesting stocks. Those are high dividend paying stocks. They're not particularly well known by investors. So maybe that's why they're being, kind of not run up as much. But with those types of dividends, man, and it looks like they can afford them. It looks like a pretty good risk reward scenario. So good luck with those. I don't see really bad red flags, and I'm trying to find them. And if you guys see them, let me know. So thanks for bringing those up. Bad Omen. Thanks for joining. I appreciate it. All right, guys. So it's back to be streaming with you guys. It's good to be back streaming. I appreciate you guys tuning in. And consider being a paid member. I would appreciate it. And you can join us on the weekends if you are. We're going to have a workshop tomorrow and then an investor only call on Sunday. Talk about stocks, talk about some stocks maybe that announced their earnings. We did what I thought was a terrific valuation last Saturday. We spent 20 minutes on, I believe it was CART. And I know it's about 30 minutes because I looked at that video and I put it on the YouTube channel. And I thought, I viewed that video and I'm like, yeah, that's exactly what I want to be doing. I think that was really, I thought really worth doing, is taking a look at a company, spending a good amount of time and, talking through it. And on that call, I wasn't the only one talking. And another investor who had done his homework was talking. And I just thought, man, that's gold. That's pure gold. So become a paid member and join us. And if you want to join us on Discord, here are the details. We are active on Discord, and here's the Discord server. Just be careful on Discord. A lot of scammers. And with that, let's keep these earnings going. Let's see what next week has in store. Everybody that's going to be on the calls over the weekend, I look forward to talking with you. And I appreciate everybody tuning in. Thank you. Everybody have a nice weekend.